Hello and welcome to the financial tip of the month from F3 Capital. I'm Nathan Fox, I'm a financial advisor, and I'm the founder and managing partner of F3 Capital. Today for the tip of the month, I got an exciting topic. I think anybody who's approaching retirement, in retirement, or simply wants to retire can get a lot of value out of today's tip. And today's tip of the month is the key to retirement. Now, the key is spending your money. You hear that from a financial advisor. It tells you the key is to spend your money. Not often, right? And the reason for it is because a lot of financial advisors focuses on accumulation, the accumulation of your wealth. Or as you ascend through your careers, they're helping you save into your qualified plans. They're helping you to save into investments and brokerage accounts. They don't quite often bring up the topic of how you're going to spend it and how, in particular, are you going to create an income distribution plan that you can't outlive. That's a better phrase for spending your money. The key is to create an income plan that you cannot outlive. Now, for those of you who are familiar with Mount Everest, which should be the majority, you may have heard of a guy named Sir Edmund Hillary. Now, he's the first person to get credit in the 20th century for conquering Mount Everest, climbing to the summit and making it down. What most people don't realize is there was two individuals, two mountaineers, George Mallory and Sandy Irvine, who actually got to the summit about 30 years before Sir Edmund Hillary. The reason they don't get any credit is they died on the way down. They never made it down. And I think that often sometimes happens with people when they plan for retirement. They get to it, but they can't quite make it through. They run out of money. In fact, the number one concern that people have with retirement planning is running out of wealth. So today, I'm going to give you 3 tips that can help make sure or put you in the highest probability of not running out of money. So let's get into this. Let's unpack this. Now, before I begin, I just want to let everyone know this is for informational purposes only. Always make sure you do due diligence. I always encourage people to work with a fiduciary. At F3 Capital, we are fiduciaries. The advice we give is always in our client's best interest. And if you happen to like this video, please give it a like. And if you have any questions, I'm going to put our information here in the link. You can contact us, schedule a complimentary consult to go into any of these topics if you want. So, to unpack this a little bit more, the first tip that I'm going to give is when you're looking to create an income stream that you can't outlive, consider using an income annuity. Now, we want to make sure that we pick out the right annuity, that we're utilizing the correct company, and that we're utilizing the appropriate amount of your portfolio. Like anything, we don't want to overdo it. We want to take a certain percent of the money you've accumulated, carve it out, and now with this annuity, create an income stream that you cannot outlive. Let's take longevity risk and the ability for you to run out of money off the table, off the board. Now, annuities are guaranteed by the claims paying ability of the insurance carrier. They are insurance products, so you want to make sure that you understand the financial ratings of the company you're choosing. But if you choose a good one, we can now create an income stream, potentially that covers your fixed expenses forever. And if you pass away, that money can continue on to your spouse. We can even have that number adjust for inflation. So annuities being carved out and used correctly in income form. And again, there are multiple types. There are annuities that are called SPIAs or immediate annuities. There are variable, there are indexed annuities. So all of these can help serve, if they have an income feature to them, to help create that income stream. You know, I think a lot of the times people get nervous with decreasing markets because they don't have their adequate income plan in retirement. If you have established a good plan that money's coming every month at the same time, you're going to be able to weather the ups and downs of the market a lot better, and it's going to be a lot better on your nerves. Tip number 2 is for individuals to make sure that they're maximizing their Social Security benefit. This is an area where I see a lot of retirees drop the ball. And the reason for it is because they don't do the analysis behind it. They just listen to some hard, fast rules, or they listen to their friends, or they get a quick piece of advice. The number one thing I can tell you about Social Security is that the decision of when to take it is highly individualized and based on your situation. It may make sense for you to take it at 62 It may make sense for you to take it at 65 or 70. It may make sense for your spouse to take it at 62 and you to take it at 70. You need to get the analysis done. At F3 Capital, we do these complementary analysis. We give all the reports and we take into consideration their entire financial life before we even think about giving any type of advice on Social Security. So if anyone watching this has listened to someone and they've given you quick advice or hard, fast rules, that can be a red flag. So be careful. The third piece of advice that I like to give for people who are concerned about longevity and really want to take care of this, this number one thing to retirement, is they can also implement what I call the 4% rule. Now, the 4% rule has come under challenge recently. I think it's been lowered in some instances to 3%. But the 3% or the 4% rule, it's a general rule. It's not meant necessarily to be the best or to be so exact, right? You want to take this and understand that every situation is different, but as a generality, a 4% rule is a good rule to stick by of how much money you should be distributing from your portfolio if you want it to last 25, 30 years. So simply put, if you have $1 million, the 4% rule would say, do not pull out more than 40 grand a year if you want to be in a high probability of your money lasting 30 plus years. Now, the caveat is that if you've implemented annuity alongside it, there might be a little bit more wiggle room on the 4% rule. If you haven't implemented an annuity and you're simply just going to do a drawdown of your portfolio, you're going to want to be a little bit more regimented in the percent you're pulling down from your portfolio. The 4% rule has been around for a long, long time, and it's really just a guideline, as I mentioned. Again, if you have questions about this, click the link in the description below, and we're happy to do the analysis for you either on decumulation or simply on Social Security. So to conclude, the key to retirement is creating an income plan, spending your money. The 3 tips that I have for you today at which you can best accomplish that is look at implementing an annuity with some portion, maximize your Social Security, and stick to the 4% rule so that you can have an income stream that you cannot outlive. Please stay tuned for more tips of the week. And if you've enjoyed this video, give it a quick like, join our YouTube channel, and please reach out with any questions that you may have. I look forward to sharing more tips of the month.